Hey everybody, and welcome back for another deep dive with us. Today we're going to be looking at something that I think is on a lot of people's minds, and that's, retiring at 62. And you know how to make those golden years really golden. So we're looking at an article here from the Motley Fool, those finance wizards, and they pointed out something that I found really interesting. That the average American actually retires at 62.
Yeah, it's a lot younger than a lot of people think. And it kind of leads into a really interesting dilemma because,
Okay.
you know, full Social Security benefits don't usually kick in until 66 or 67, depending on when you were born.
Right, exactly. So you've got this gap. If you retire at 62, you've got this 4 to 5 year gap where you're really relying on your own savings to bridge that time until you hit your full Social Security. So that's where smart investing, becomes even more crucial.
Yeah, you can think about it like, you're trying to build a bridge to those full Social Security benefits, and the savings that you've got are like the beams holding that bridge up. So the sturdier those booms are, the smoother the journey is going to be. And that's really what this Motley Fool article is all about. It's trying to help people retire early without having to sacrifice their quality of life. And they've picked out 3 stocks that they think are in the sweet spot, of growth potential, but without being too risky.
Okay, hit me with the first one.
All right, so the first one might come as a little bit of a surprise. It's PepsiCo, not Coke Pepsi.
Wait, Pepsi really? What makes them such a good retirement stock?
Well, the Motley Fool really points to their business model. So unlike Coca-Cola, which really relies on other companies to bottle their drinks, PepsiCo actually owns a lot of its own production facilities. So they basically control the entire process, from ingredients to the final sip.
Okay, so that's got to give them more control over, the supply chain and even adapting to
Sure.
changing consumer tastes and things.
Well, absolutely, more control. And it's interesting because the article actually shows a chart where over the past 30 years, PepsiCo has actually outperformed Coca-Cola in terms of total return, assuming that you're reinvesting those dividends.
So it's not just about the sugary goodness. It's about a solid business strategy. But let's talk about those dividends. How does PepsiCo stack up there?
This is where it gets really interesting. PepsiCo has increased its dividend for 52 years straight.
Wow, 52 years.
Yeah, that's like the kind of reliability that you really want for retirement. It's that steady, dependable friend that you can always count on.
I like that. Okay, so PepsiCo, I'm intrigued. What's the next stock that the Motley Fool thinks could be good for retirement?
So the next one is a little bit more of a household name. It's Amazon.
Amazon, huh? Isn't that a little bit of an obvious choice? I feel like everybody and their grandma owns a piece of Amazon these days.
Yeah, it's popular for a reason. But the Motley Fool is really zeroing in on 2 areas of growth for Amazon: cloud computing and e-commerce.
All right, let's break those down. So starting with cloud computing, Amazon Web Services or AWS, that's their cloud baby, right?
Yeah, exactly. It's kind of like the engine room of the internet. And there's this wild stat that really stood out to me. AWS makes up about 17% of Amazon's total revenue. But it brings in like a whopping 60% of their operating income.
Wait, hold on. 17% of revenue is 60% of profit?
It's crazy, right?
Yeah.
And that tells you that the profit margin on AWS is just so much higher than their other businesses.
Yeah.
It's like selling, a really high-end sports car versus selling like a bunch of economy sedans. And on top of that, Goldman Sachs is actually predicting that the global cloud computing market is going to be worth like $2 trillion by 2030.
$2 trillion?
Yeah, it's astronomical.
Really?
So even though AWS is already this giant, there's still a lot of room for growth there.
Okay, so what about e-commerce? I mean, Amazon's already king of online shopping, right?
They are. But what's interesting is how they're kind of shifting their focus. In the past, it was all about just growing as fast as possible. But now they're really focusing on squeezing more profit out of each sale, which could really change the game for their bottom line. It's like they've gone from, running a sprint to running a marathon, and now they're really pacing themselves for the long haul.
And the article pointed out that they've got a long way to go, too. They pulled some numbers from the U.S. Census Bureau, and only about 16% of retail sales in the U.S. happen online right now.
Yeah, so that means there's still a huge chunk of the pie that could potentially shift online. And, globally, it's even bigger. So we're really still in the early innings of this e-commerce revolution, which is good news for companies like Amazon.
Okay, 2 down, 1 to go. What's the final stock pick that the Motley Fool thinks could fuel a comfortable retirement?
This one's a little more under the radar. It's a company called Wolfspeed.
Wolfspeed. I've never heard of them.
Yeah, they're in a really interesting niche. They make energy equipment using silicon carbide. It's kind of like this super material that makes components more durable and powerful.
Silicon carbide. Okay, break that down for me. What exactly does silicon carbide do, and why should I care?
So imagine you're upgrading your computer, from like an old clunky hard drive
Yeah.
to a lightning-fast, solid-state drive. Silicon carbide is kind of like that for a lot of industries. It makes components much more efficient and powerful,
Yeah.
especially in energy equipment.
So where does Wolfspeed fit into all this?
Well, they're kind of at the forefront of using silicon carbide in all sorts of things like data centers, solar power, heat pumps. But here's the really interesting part. Electric vehicles.
Electric vehicles. What does silicon carbide have to do with electric cars?
So electric vehicles need really sophisticated power electronics to kind of manage the flow of energy between the battery, the motor, and all the other systems. It's like the nervous system of the car. And silicon carbide, because it can handle such high power and heat, it's really perfect for this task.
So as electric vehicles get more and more popular, the demand for silicon carbide and Wolfspeed is just going to keep going up.
Exactly. It's like this chain reaction.
Hmm.
The growth of EVs is going to create this ripple effect. And companies like Wolfspeed that are supplying these components are going to benefit. They're really in the right place at the right time.
So is Wolfspeed a gamble then? Is that how the Motley Fool's positioning them?
Well, there's definitely an element of risk there. Their revenue is actually expected to dip a little bit this year, which might seem kind of counterintuitive with all this talk of growth.
So what's the catch?
Well, sometimes you have to take a step back before you can leap forward, right?
Mm-hmm.
And Wolfspeed's investing really heavily in expanding its production to meet this anticipated surge in demand for silicon carbide. So that upfront investment is kind of impacting their revenue right now. But it's really positioning them for explosive growth in the years to come.
Okay, so a short-term hit for a potential long-term gain. What kind of growth are we talking here?
Analysts are predicting some pretty impressive numbers. They're saying over 42% growth next year, and then a whopping 57% the year after that.
Wow, those are some big numbers. So even though it's a little riskier than, say, PepsiCo or Amazon, Wolfspeed could be a way to ride that silicon carbide wave, which is tied directly to the booming EV market.
Exactly. It's a bet on the future of transportation and potentially a very lucrative one. But remember, every investment's going to have its own risks and rewards. So it's about finding that right balance for your personal circumstances.
That's a great point, and one that we'll definitely dig into more as we continue this deep dive. So we've covered 3 very different stocks, PepsiCo, Amazon, and this intriguing Wolfspeed. What's the common thread here? How do these companies all tie back to the idea of retiring comfortably at 62?
That's the million-dollar question, right? And that's what we're going to unpack in the next part of our deep dive, so stay tuned. So we've got our 3 contenders here. We've got PepsiCo, that steady dividend payer, Amazon, that e-commerce and cloud titan. Then we've got Wolfspeed kind of riding that silicon carbide wave. They're all in really different lanes.
Yeah.
But the Motley Fool thinks that they can all contribute to a comfortable retirement, especially if you're aiming for that 62 exit.
It's funny. When I think about retirement, I picture myself relaxing on a beach somewhere, not, thinking about analyzing silicon carbide. But you're right. It is about building that financial foundation to support those dreams.
Yeah, exactly. And that's where that idea of risk tolerance comes in. Imagine you have 3 different bridges to that retirement dream. PepsiCo is kind of like that sturdy, well-maintained bridge that's been around forever. It's reliable, but maybe not the fastest route. Amazon's more like a modern suspension bridge. It might sway a little bit more, but it can handle a lot of traffic and get you there quicker. And then Wolfspeed, that's like a brand new cutting-edge bridge. Potentially the fastest route, but with a little more uncertainty.
Okay. I love that analogy. It really does paint a picture of how different these approaches can be. So how do we figure out which bridge, or should I say which stock, is right for someone who's aiming to retire at 62?
Well, it all comes down to your individual circumstances and goals, and really how much risk you're comfortable with. So someone who's at a longer time horizon. Maybe they're 10 or 20 years out from retirement. They might be more comfortable taking a riskier path with something like Wolfspeed. They've got more time to ride out any bumps in the road.
But someone who's closer to retirement, maybe like 5 years out, they might prefer the stability of those PepsiCo dividends, right? They're not looking for explosive growth. They're just looking for that reliable income.
Exactly. The closer you are to that finish line, the more you might want to shift towards a more conservative approach. Focus on preserving what you've built and generating that income to kind of supplement those early retirement years.
It's kind of like choosing the right running shoes for a race, right? You wouldn't wear sprinting spikes for a marathon.
Exactly. You need the right gear for the journey. And that's why diversification is so important. Just like you wouldn't put all your eggs in one basket. You don't want to bet your entire retirement on a single stock. So by spreading your investments across different types of assets, things like stocks, bonds, real estate, you're creating a more balanced portfolio.
So it's all about finding that right mix, the right combination of bridges, if you will, to reach that retirement destination.
Exactly. But even the best laid plans, they can be affected by factors outside of our control. The market can be unpredictable, and past performance is never a guarantee of future results.
That's true. That's a sobering thought. So even if you've got a solid plan and a diversified portfolio, there's always an element of risk.
Absolutely. But that's where informed decision-making comes in. By understanding the trends and the drivers of a company or an industry, like we're talking about today with these 3 companies, you can make more educated guesses about their future potential.
And that's why resources like the Motley Fool can be so valuable, right? They do a lot of that research and analysis for us, which can save individual investors a lot of time and effort.
For sure. Of course, it's always wise to do your own research. You don't want to just blindly follow any single source of information. But articles like the one we're discussing today, they can be a really great starting point. It's kind of like a springboard to dive deeper into the areas that really resonate with you.
They're giving us the map, but we still have to choose our own path.
Exactly. And sometimes the most rewarding discoveries are made when you venture off that beaten path. Speaking of venturing, let's circle back to that idea of retiring at 62. It's a dream for many, but it takes careful planning. And honestly, a bit of soul-searching.
Soul-searching? You mean more than just crunching numbers and picking stocks?
Absolutely. Retiring early isn't just a financial decision. It's a lifestyle choice. It's about envisioning what you want those early retirement years to look like and making sure your financial plan kind of aligns with those aspirations.
It's like planning a grand adventure, You need to know your destination, but you also need to know what you want to experience along the way. Do you want to travel the world? Do you want to pursue hobbies, spend more time with loved ones? Your financial plan should support those goals.
Exactly. And that's where things like healthcare costs, potential inflation, even the emotional impact of leaving the workforce, all that comes into play. You got to look the big picture, not just the bottom line.
So it sounds like retiring at 62, it's really a multifaceted decision. It's not just about having enough money, it's about having the right mindset and the right plan to make the most of those extra years.
You got it. It's about aligning your financial reality with your life goals. And sometimes that might even mean delaying retirement a little bit, just to make sure that you're truly ready for the journey. It's a personal decision, and there's no one-size-fits-all answer.
Which brings us back to our 3 stocks here, PepsiCo, Amazon, and Wolfspeed. How do these companies fit into this bigger picture of early retirement planning? How can they help someone, like our listener, who's maybe considering calling it quits at 62?
That's a great question, and it's one that we're going to explore in more detail as we wrap up our deep dive. So stay with us.
Okay, we're back. And, I'm really curious to tie all this together. We've got these 3 stocks, PepsiCo, Amazon, Wolfspeed, each with their own sort of personality and their own risk profile. So how can our listener who's thinking about that 62 retirement actually use this information?
Yeah, well, it's all about connecting these companies back to your own individual retirement goals. And importantly, your own risk tolerance.
Okay, let's break that down. Let's say our listener is somebody who really values stability. Maybe they've seen the market go up and down, and they just want something that feels safe and reliable.
Right. Well, in that case, PepsiCo might be a good fit. It's the kind of company that you could see yourself holding for years and years, reinvesting those dividends and just kind of watching it grow steadily over time. It's kind of like a sturdy oak tree, It might not grow the fastest, but it's resilient and dependable.
But what if our listener is a little more adventurous, someone who's okay with a few more ups and downs, as long as there's a potential for a bigger payoff down the road?
Yeah, then Amazon might be a better fit. I mean, it's a company that's constantly innovating, pushing boundaries, disrupting industries. So there's definitely more volatility there, but the potential returns could be much higher as well. It's kind of like investing in a high-growth tech startup. There's risk involved, but there's also the possibility of really hitting it big.
And where does Wolfspeed fit into all of this on that kind of risk spectrum?
Wolfspeed is definitely the wild card, the one with the most potential, but also the most uncertainty. It's a bet on the future of technology, specifically on silicon carbide being adopted and the whole electric vehicle revolution. It's kind of like investing in a promising young athlete. They might become a superstar, but there's no guarantee they'll even make it to the big leagues.
So it's almost like choose your own adventure, right? You decide how much risk you're comfortable with, and then you pick the stocks that align with that.
Exactly. But remember, diversification is still important.
Yeah.
Even if you are a risk taker, you wouldn't put all your money on one horse in a race, would you? So it's about spreading your bets, building that portfolio that has a good balance of risk and reward.
And this is where working with a financial advisor can be so helpful, right? They can help you figure out how much risk you're comfortable with and what your goals are and really create a plan that's tailored to you.
Absolutely. And they can also help you navigate all the complexities of retirement planning. Things like managing your taxes, figuring out how to withdraw your money. It's kind of like having a guide for your retirement journey, someone who's been there and done that.
So the big takeaway is there's no one right way to retire at 62. It's about knowing yourself, knowing what your goals are, how much risk you can stomach, and making smart decisions about how to invest your savings.
Couldn't have said it better myself. It's about taking control of your future and making sure those golden years are truly golden.
Well said. And remember, everyone, this is just a starting point. Do your research, talk to a financial advisor. And most importantly, don't be afraid to ask questions. The more you know, the better prepared you'll be to make those big decisions about your retirement. Thanks for joining us for another deep dive.